On today's IRS tax refund update, as we enter into the new year, we are just weeks away from the start of the tax filing season. So we will take a look at the latest, including what will be some of the top reasons for those refund delays, including holds due to the PATH Act, as well as the top notices the IRS will send out this tax season for those experiencing delays, and guidance on the new car interest loan deduction that viewers have been asking about. Now, we are still awaiting word from the IRS on the official start date of the tax season. However, based on previous years, that looks like it will be either Monday, January 19th or January 26th. And as a reminder to those of you early filers, please make sure you have received all W-2s and/or 1099 forms when filing your taxes, as we have seen in previous years a number of tax filers in a rush to file forgetting some of these forms and being forced later to file an amended tax return, which delayed their tax refunds in some cases by months. Meanwhile, we have seen the child tax credit permanently increase to $2,200 per child, with annual adjustments for inflation every year. Meanwhile, electric vehicle credits that were worth up to $7,500 can no longer be claimed for EVs purchased after September 30th, 2025, while the state and local tax deduction cap saw an increase from $10,000 to $40,000 a year starting in tax year 2025 to be filed on this year's tax returns. So do take note if you are impacted by any of these changes. As a reminder for those of you early filers, if you are claiming either the Earned Income Tax Credit or additional child tax credit, that your refunds will be on hold until mid-February due to the PATH Act, which is federal law that is in place to allow the IRS additional processing time to review the claims for those credits. Now, when it comes to specifically to the child tax credit, this rule applies to the advanced child tax credit portion and not the standard child tax credit, which often causes confusion each year, and no refund containing either EITC or ACTC will be released before mid-February. Recapping some of the top notices that will be sent out by the IRS this tax season, including IRS Letter 2644C, also known as the 30-day notice, which is sent by the IRS to impacted tax filers that the processing of their tax return is taking additional time. And a major reason for this letter being sent out is the IRS still needs to review the tax information provided by the tax filers, employer-specifically wage information, so they can match what your employer reported and compare it to your return for accuracy. And it is not uncommon to receive several of these letters while waiting for your return to be processed and refund issued. Another letter is from the CP05 series of notices, which is when the IRS is requesting additional documentation from you, specifically wage documents such as pay stubs or tax forms, confirming what you entered on your tax return is correct before processing can continue, as well as the CP75 letter, which is sent to those claiming certain tax credits like the Earned Income Tax Credit, asking the tax filer to provide specific documentation as it relates to their dependents, such as a birth certificate and/or proof of residency. Meanwhile, taxpayers who buy a new car assembled in the U.S. may be able to deduct up to $10,000 on their tax returns beginning in 2025, and it should be noted the new deduction for car loan interest is temporary and applies to the tax years 2025 through 2028. For purposes of the deduction, a qualified passenger vehicle is a car, minivan, van, SUV, pickup truck, or motorcycle with a gross vehicle weight rating of less than 14,000 pounds, and that has undergone final assembly in the United States. And you can determine where a vehicle was final assembled by checking the vehicle's information label or using the Vehicle Identification Number, VIN. By law, every vehicle has a VIN displayed on a dashboard sticker or plaque. The 17-digit VIN is a unique combination of numbers and letters that identifies your vehicle. A VIN starting with 1, 4, or 5 typically indicates the vehicle was made in the U.S. To qualify for the deduction, the interest must be paid on a loan that originates after December 31st, 2024. To purchase a vehicle, and leased vehicles do not qualify, and the vehicle's original use must start with you. And the deduction applies to interest paid on a loan for a personal use vehicle, not for business or commercial use, and must be secured by a lien on the vehicle. Also note, you can deduct interest up to the $10,000 cap, but keep in mind that this is a deduction for interest paid, not the total car payment. Let us know in the comment section below about your ongoing tax issue. In the meantime, we will keep monitoring the situation for further developments, so make sure to click on the thumbs up and subscribe button below for future updates on this channel and thanks for watching.